one thing you know about the bond market is there's actually a very strong correlation between the yield you get today and the return you're going to get over the next 5 years. It's pretty much the same number. So you buy 4.5% bonds and you'll get paid 4.5%. It's pretty low drama, and there's nothing wrong with that. I think I wouldn't knock that at all. I think it needs an allocation in there, and if something does go wrong with the equity market, then bonds will rally, and that'll help you out. They will zig a bit if the stocks zag.
Hello, and welcome to the Healthy Wealth Experience. I am your host, Chris Hall, and I have a special guest today, Dr. David Kelly, who is the Chief Global Strategist and Head of Global Market Insights at JP Morgan's Asset Management. Welcome to the show, David.
Very glad to be here, Chris.
All right. Thank you so much. So one of the reasons that we have David on the show, obviously he has a lot of great insight about the market, but he's also a marathon runner. And we thought that was such a correlation for the healthy wealth, right? It's not just about wealth, it's also about health. And so that's one of the reasons we asked him, reach out to David, and he was nice enough to oblige. So let's start with that. The obvious, like, where are you from, sir?
I'm from Ireland, and I grew up in Dublin. I've been running all my life, apart from everything else I do. But I started out running because I used to play rugby, but I'm really not big and beefy enough to play rugby. So and at one stage we had the good fortune to have a New Zealand rugby coach teach us, and he took one look at the slobby bunch of us and sent us out on a long run. And at that point I decided, well, I really actually kind of like long distance running. That's kind of, it's fun. It's kind of my zen thing. Although I'm not cut out for rugby. So I really, since a teenager, I've been just running, and in the last 10 years, I took up marathon running. So that's been kind of fun.
Yeah. So it's funny that you started in rugby and ended up in running, where I coach football, and I've been around football a long time. And sometimes we run so much, sometimes I think we are like a running team with like a pair of cleats.
Yeah.
It's nice how they go hand in hand.
Mm-hmm.
So we're going to talk about your running. We're going to talk about the markets. So if you're listening right now, we're definitely going to get some insights on what's going on in the market, what David thinks is something we should be looking for, things like that. But I definitely want to spend a little bit of time on the health side of it as well. So obviously you're very busy, operating at a high level. How do you find time to get your runs in and things like that? Because you're not just getting 20 minutes on the treadmill. I mean, you're a marathon runner, so you're getting tons of runs in.
That's right. And the first thing I do is I control my own schedule. Nobody has access to my calendar, or at least the general organization doesn't have access to my calendar. So, when I plan trips, if I'm going to be overnight somewhere, I always sort of make sure the first meeting isn't too early and figure out running routes. And I just pack the running shoes and the gear and just go out for a long run. It's I don't wear headphones. I've traveled all over the world. It's actually one of the nicest ways to see a city, because instead of doing all the tourist traps, you just just run around the place, and you just bump into ordinary people from Chile or Japan or whatever as you're running around the streets. But I make it a priority. I tell this to my team also. I'm not looking for you to put in the most number of hours. I'm looking for you to give us the best possible output. And if your ideas come to you when you're running, and a lot of ideas come to me when I'm running, that's all to the good. It's looking after your personal health. It can actually help you be much better at your job.
No, I totally agree with that. When I first started as a financial advisor, I was working 6 a.m. to 6 p.m. Monday through Friday. I was going out on the weekends. I was actually, knocking on doors, because that's what they did back then, and doing the whole thing. And I remember I was building my business pretty rapidly and enjoying it. But in the same respect, I probably was never as unhealthy as I was during that moment. I'd say it was about 6 months in, and I went, I've got to change this. And I ended up just going back to the gym and like you said, just prioritizing it, making it part of my schedule. And I found that even though I had less production, hours, I was more productive in those hours. So
that's right. I think it's a very important part of being a human. As I said, I took up marathon running about 10 years ago, and I remember going for a very long run with this professor out of Harvard, who is a evolutionary biologist, and that's actually not the exact word phrase, but sorry, evolutionary anthropologist, and he was talking about just how our distant ancestors used to go out on long runs. I mean, they would run in groups, chasing after the wildebeest or whatever. And the one thing that humans were very good at doing was very slow, long distance running. We are really built for slow, long distance running. And the modern world doesn't put that opportunity in front of us, but if we do it, it helps the whole pile of health conditions. It brings down your blood pressure, clears your mind, gives you a certain sense of peace. It's really something that humans should do because we're really built to do that.
Yeah. Yeah. So when you say running like the long distances, so you started out, just running and now you're running marathons. What's your average run like today? Like what do you, like if you go out 3 or 4 times a week, what do you usually put in?
Well, usually I have one run that's longer than the others, and if I'm training for a marathon, then that long run builds up to a peak of 20 miles. But in a normal week, I'd run 5 or 6 miles 3 or 4 times during the week, and then run like 10 miles on a Saturday, and that's kind of what I do. And it's most of it's really slow, but I always put in a tempo run or interval training or something just to sort of speed things up and give my system a bit of a kick in the rear end, which it needs. But most of it's slow. People slow running builds mitochondria. It just gives you energy, and it's as I say, it's something I like just as much as I like strategy in the economy.
How often do you go for a run? Do you go out every day?
About no, not every day. About 5 days a week. If you go for a very long run, or if you do tempo training or something that's kind of stressful, you do kind of have to back off the next day and just let the old muscles, and the muscles are getting older, so I have to respect my body and just let it relax. Even though I'd like to go out for another run, but no, I gotta back
Okay.
off.
All right.
It's about
Oh,
four or
that's
five times
great.
a week.
That's great. And then so when it comes to, like wealth management and things like that, do you feel like it gives you an edge to have the cardiovascular health that you have, the flexibility to kind of get up and go?
Well, it does in a few ways. I mean, first of all, I have to in my job. Sometimes I have very stressful days in New York where I'm going from one meeting to another meeting, and I've got 5 minutes between this and 2 minutes between that, and I'm literally running from meeting to meeting and dealing with all of things. It gives you the energy, just a sheer energy to go through the day and not be completely beaten to a pulp at the end. And also, I travel and I sort of fight the U.S. airline system, the international airline system. And if you get in late at night, all of these things, particularly as you get older, having base high, what the doctors would call a high VO2 max, really actually allows you to endure this without it just knocking you for a loop. It also, obviously prevents you getting as many illnesses, colds, and that's a very. If you do a lot of public speaking like I do, getting a cold is just the most miserable thing because without your voice, you got nothing. So
Right.
I think it's actually very important for me to do my job well.
Yeah, that's great. Do you also watch what you eat, or are you more of like I do this so I don't have to do that?
No, no, both of them. It's kind of. I think I'm kind of unique in my family because everybody else sort of really enjoys the taste of this, the taste of that. And I do think about food as a little bit as fuel. I mean,
Hmm.
I'm a morning person, so I always get up and have just lots of oatmeals and raisins and skim milk and all that stuff. I'm pretty careful about it, but I don't feel like it's a burden to me. I feel like it's like when you're filling up your car with gas, you're going to put in the expensive stuff. You're going to put in the cheap stuff, and I'm going to put the expensive stuff in. It's my body. I'm not gonna mistreat it. So I try to be mindful about not filling myself with stuff that's just not good for me.
I love that. That's great. Well, I mean, and obviously because of your job, you have to be a morning person, really.
Yeah, I mean, I've seen both, but it works well for me. And I get up at 5 pretty much every morning, and I just start writing before the phones start ringing or anybody needs to bother me. I just start writing and thinking, and that's done.
So, how did you become the chief global strategist and head of global market insights for JP Morgan? What does a pathway like that look like?
Well, it's a bit of a winding road. My father was a politician in Ireland. I thought I was originally going to go into politics, but he was a lawyer. And although he's a very skilled public speaker, he didn't really have any particular background in economics. And I sort of felt like, well, I can't go into politics unless I know some economics. So I then did an undergraduate degree in economics. And then I felt like, well, I still don't know anything about economics. So then I did a PhD in economics over in America and in Michigan. And then I met my wife while I was studying got my PhD from Michigan State. And so then I decided to stay here, and so I became an economist, worked for an economic consulting firm. Then I worked for the Boston Company Economic Advisors, which was taken over by Lehman Brothers. Then I worked for Putnam Investments in Boston, and then just before the financial crisis started in January 1st of 2008, I moved over to J.P. Morgan as a strategist, and
Yeah.
so there are lots of twists and turns along the way.
Did you, I mean, is that something you thought you would want to do, or just kind of like you just kept moving through economics and it just became more like, oh, this is where I'm going to go? Or how did you feel like, I mean, that's not something people grow up and say, I want to be the chief global strategist, you know?
No, no. So I've always been interested in economics because economics is just another lens of a way of looking at the world. You can look at the world through anthropology or biology or physics or chemistry for that matter, or political analysis, but I look at it through economic analysis. And I think you can see a lot of what goes on in the world. You can understand a lot about how the world works by understanding economics. So I found it fascinating anyway. And it can also be helpful to people if you tell people the right thing to do versus the wrong thing to do, just like financial advice. But over time, I did a PhD in economics. I could have gone and taught, but I realized I need to feed a family. And people don't pay people for economic advice. It has to have some point. And so I realized quite quickly that the point that people would pay for is investment strategy. And so at that point, I sort of pivoted and worked on the investment side of economic analysis. And that's really what I've been doing ever since.
Yeah. That's great. That's great. I mean, it's really, and spoke off the air with you, like I watch your stuff and you're on like CNBC quite a bit, right? Yeah.
Yeah, I've been doing it for a long time. They're a very nice bunch of people, and we get to talk about the thing about economics and finance is it always changes. A story is different. Every week you start off with a slightly different story. You just got to interpret what's going on. So it's always interesting.
Yeah. So let's actually dig into that a little bit. I just saw something, like a month ago from you, talking about how the market seems to not be paying attention to some of the factors that are out there. And it
Hmm.
just kind of keeps going up.
Yep.
But then, of course, in the last week or so, it's down, 2 or 3%. Do you feel like the market is catching up to the data, or do you feel like that's what's happening right now, or is it just like more of like a blip type of a thing?
Well, I think there's, I talked earlier about the different lenses of looking at the world, but there are really three different ways you could look at things right now. You could look at the world, the U.S. in terms of consumer confidence, and it has rarely been worse. The University of Michigan Index of Consumer Sentiment for early November was 50.3, and there's only 1 month in the last 50 years that was lower than that. So people feel pretty miserable about where things are. They think the economy is falling apart, and they think their personal economy is just miserable. You could then look at the economy itself, which I would argue is boring, but reasonably healthy. I mean, I'd give it sort of a C minus in terms of its actual health. And then you look at the market, which is all sort of champagne and bubbles, and I think what's going on here is there's been a disconnect between the market and the economy for a long time, and it's growing. And the reason for that disconnect, I think, is a lot to do with actually the way people invest and the Federal Reserve. I think over time, the Federal Reserve cut rates to very low levels. That starts asset prices rising. And then once asset prices have gone up enough, people face a rather interesting capital gains dilemma. They've got all these embedded capital gains, but if it's not in a tax protected account, if they sell, they have to write a check immediately to Uncle Sam for the capital gains. If, on the other hand, they hold on and they pass it on to their heirs, for example, which would be the case for many people, the basis resets and nobody ever has to pay the capital gains tax. So it's really hard to make the decision to get out of the market. It's pretty easy to make a decision to get into the market. Another thing that's happened is, years ago, there used to be a lot of defined benefit pension plans, and these were run by fiduciaries who'd rebalance all the time. Now it's all defined contribution, and people aren't rebalancing their 401ks. If it's going up, it's going up, and they just leave it. But that means you're getting more and more of a concentration in these tech names. Again, there's more and more money going into the markets. It's like a stuck valve. Money can go in, but it's really hard to come out. And I think that's why the market's been outperforming the economy.
Right. Right. Yeah. And so, like as a financial advisor, one of the things I do quite a bit is I try to rebalance people, you know what I mean? So like when the market's down, we try to pull some money out of their bonds portfolio. And then, I call it the war chest. I didn't signify, that's not something I invented, but I just really like doing that, calling it that. And then, when the market's doing really well, like it is, right now, this is another time to rebalance, to pull money out of the market and put it into bonds. And then again, not all of it or anything like that. But so you're finding that just people aren't rebalancing on the way up. They're just They're
Well,
just kind
yeah,
of ignoring it and staying letting it ride.
they don't, because it's tricky. I mean, you do have to find, if you can, some tax efficient way of doing it. So I always tell people, or certainly I tell people, but also in my own case, I always treat fresh money with the greatest of respect, because this is the money that I can actually use to rebalance without having to pay capital gains tax. So any bit of money that comes to me that isn't already embedded capital gains, I try to put on the other side of the ship to try and rebalance it. Of it, of course, is about getting better returns in the long run, but a lot of it's just about risk mitigation. You want to make sure that, because I know the market's down a bit this week, and we'll see what it is next week, and we don't know. But sooner or later, there's going to be a big bear market, and not the hour nor the day, but you do know the location. The location of a bear market is always centered on the area of the biggest froth and frenzy in the first place. And so if that's where you're overweight, that's what you're trying to reduce your exposure to by increasing your exposure to other things. And that's obviously I try to do.
Right. And obviously you're referring to, one of the questions that everybody has right now is, where are we in an AI bubble?
Yeah.
Was that where we're at with the conditions of the market, that where they are?
Yeah, it's really interesting. I mean, I don't think it's a 2008 situation, because in 2008, the way the housing finance was interconnected with the global economy and the sort of derivative trades around it really left the entire banking system vulnerable, as we saw obviously with the collapse of Lehman Brothers. And that turned what should have been a housing correction into a global financial crisis. I don't think we have that problem. I don't think it's quite the same as the internet bubble, although it's quite like, but it's not exactly the same as the internet bubble of 1999, because then you were dealing with a lot of little companies who didn't have any cash flow. They didn't even have an office cat. They just had people looking at their internet screen. And so these were very vulnerable companies. And so when they went down, they went down. In this case, this boom in AI investment is being powered by some of the most profitable companies the world has ever seen. I would argue the most profitable companies the world has ever seen. And so they've got tremendous free cash flow anyway to pump into all this capital spending, all these data centers, the purchase of all this electricity. And that can keep this ball rolling for some time. However, I don't think that all these companies have got a clear vision as to exactly who is going to pay for what in terms of AI services 5 years from now. And that's really the crux of the problem. Some of this stuff is really useful. I think, for example, the uses of AI in radiology could be very useful to the human race. Other things like, I'm sure if I asked ChatGPT to give me the best possible, blueberry torte recipe, that all the computers in the desert would be whirring away, consuming vast quantities of electricity to give me that answer. But it's not actually a useful answer. And the question is, how many things can this somewhat infantile AI do? It's a different kind of machine. I mean, we think about machines as being very narrow but very precise, like a calculator. But that's not what AI is. AI is very broad but kind of flaky.
Mm-hmm.
It can give you a completely wrong answer because consensus happens to be wrong answer, and and they will try and refine it, but we're not there yet. And so I think the real question is, will there be a genuine stream of revenue that is sufficient to pay for the incredible amount of physical investment that's going on around building out this AI infrastructure? And if there isn't that investment, then somebody's going to go to the wall. Now, the two lessons from the internet bubble and the dot-com bubble. One is that you can lose a whole lot of money by betting on the wrong companies or by not being diversified. I always remember that between 2000 and 2002, the S&P 500 fell about 50%. The NASDAQ fell by 80%. And there's a big difference between an 80% drop and a 50% drop. And so I think people need to think about that. And but also, even though that boom went bust, there was something real there. I mean, the internet did change our lives and change the world. And some of the companies that were booming before then are still booming today. Most of them aren't, but some of them turned out to be these extraordinary financial winners. And so I think there'll be some extraordinary winners too, but there'll be some losers, and there's probably going to be a boom and a bust in between. And so that's why you have to sort of be careful about how you place AI bets and don't just buy into all the hype.
Yeah, I think that's a really good example. I actually have a good personal example of how I got beat up pretty good in the dot-com bubble. Do you remember a company called Juno?
Yep.
Yeah.
Yep.
So I remember Juno was just rising one day, just, very young investor at this
Hmm.
time. It was just crushing it. And so I actually put money in. It was like $28.
Hmm.
I bought it at $58 in one day. By the end of that day, it closed at $78. I made $2,000. I mean, again, I'm not an early investor, so that was a lot of money, but I made $2,000 that day. And then the next morning we woke up and it was literally like opened at $58. So I was like, oh, well, I didn't make any money, but I didn't lose any money. Fast forward through the whole dot-com bubble, that was never a very profitable company. They
Hmm.
basically were worthless, and I had to end selling it for the capital losses to offset some of my other games. I think a share price was like 1/1000th of a penny or something by the time I was done with it.
I suppose it's the way. I mean, given if as soon as we do have a bust, people will be able to deal with their capital gains, their embedded capital gains problem.
It's a very glass, it's a
But
very
no,
glass
that's
half full attitude.
and the market has got a habit of rebalancing for you if you don't do it yourself.
Right, right. So that's a good question. Well, I mean, like, what are you suggesting people do at this point? I obviously you have capital gains, and that's something that they're going to have
Yeah,
to just like
yeah.
figure out, But like, let's just talk about qualified accounts, 401ks, IRAs, defined benefit, like we talked about earlier. Like, if you're like a normal 80/20 guy, like let's say you have 80% of your money in the stock market, 20% of your money in the bond market. Is this a good time to kind of like go ratchet down to like 75/25, or should you go down even further than that? Should you start, pulling back even more than that? What's your thoughts on
I think
that?
that I think that's. I mean, that split would be. I would regard it as a little aggressive if you're in retirement, but
True.
if you're younger, no problem. But I think the real question isn't really the bond stock split; it's switch stocks. Because if you look, the mega cap growth stocks are very expensive. The rest of the US market it's not cheap, but it's not as expensive. So the first thing I'd do is try to, I'd be okay with putting some more money in the US market outside of, say, the top 10 companies or whatever. But also, I mean, the big thing is international. Because, we have a chart and we put together the guide to the markets. I don't know if you've seen our guide to the markets, but
Yes.
we have a chart where we show these ranges of valuations for different markets around the world, in the US and Japan and UK and China and EM, and it's like that Sesame Street song. Well, one of these bars is not like the others. I mean, the US is very expensive, and nothing else is very expensive. There's nothing really expensive about Japanese stocks or UK stocks or Eurozone stocks or Chinese stocks. They're all kind of at normal valuations. This has been a US boom, and the question is, do you really want to have all your eggs in that US basket? Right now, the US is 65% of all the stocks in the world are US stocks, which is an extraordinarily high number. But how many people can honestly say that 35% of their stock exposure is outside the US? The vast
No.
majority of
Yeah.
Americans is way below that, maybe 20%, 10%. So the first thing is, if you've got extra money, put it in non-US stocks.
Yeah. Yeah. I would.
Basically, there are stocks that are going to do the sort of things that stocks do. If the dollar comes down some more, and I'd argue it probably will over the next decade and maybe even over the next few years, then that's going to amplify your return. But you can stay long the stock market. It just doesn't have to all be US stocks.
Yeah. No, I like that. That's really good. And again, like the top 10 stocks has been what's really running everything. But it's also, those are probably the most like overpriced, if you will. And so that makes perfect sense to find things that, like anything else, you go in the grocery store and maybe go look for some things that are on sale.
Well, absolutely, absolutely. I mean, I had an old friend, very old friend in this business, a guy called Don Connolly, who used to say that it's stock's the weirdest thing because everything else in the grocery store, it's on sale, you buy it, and in the stock market, you just run away from it. You just want to buy the most expensive stuff. Why do we do that?
Right. Or I always thought as a financial advisor, when things go on sale, we go buy more of it. Right. But in the stock market, if something goes on sale, if something dips in price, we're trying to figure out how to get it out of our cabinet, take it to the grocery store and sell it back to them,
Yeah.
that's not a good way to do it either.
Yeah, exactly. I think, but in general, look at valuations because if you in the long run, I think the U.S. economy is going to be fine. I think the global economy is going to be fine. But there's a lot of tension in the U.S. market right now, and I do think there's a possibility of a significant correction. You just don't want to be overweight the most expensive stuff.
Right. I like that a lot. That's very good advice. Thank you for that. I also wanted to talk about, just because like you very rarely get a chance to like have someone of your caliber, to ask these questions too, but what do you think about gold and its massive run up over the last few years? Like, do you think this has got holding power, or is this just kind of a way of saying like, yeah, inflation was terrible, this is how we're going to get, a hedge against it? What do you feel like gold has done in the last couple of years, and what do you think it'll probably continue to do?
Well, I think so. It used to be that gold was pretty reliable as an inflation hedge and also as a hedge against geopolitical turmoil. But if you look at that, that was its historic role. But then we've seen periods where inflation's gone up and gold didn't do anything. Then when inflation comes down, gold takes off. And then when you've got severe geopolitical tensions, it's not really helping you out. So it's an animal that's kind of changes stripes over time. And what I think has really happened is we've had a lot of liquidity in this market, and money's been pouring, sloshing around, going into this area and going into that area. And I think that people who want to balance out a portfolio, they know they've got a lot of risky stuff. And they are worried about things. I mean, people are worried about the government debt. They're worried about where everything is going. And so the idea that they could put something money in a solid, tangible asset like gold, I think has had some appeal to individual investors. I think that's helped. I think a lot of international central banks, they don't necessarily want to build up their US dollar denominated holdings, so that they've been building up their gold holdings. And I think that's created some demand. And any little bit of extra demand for gold will push the price up because the supply is completely inelastic. I mean, the world's supply of gold, refined gold, goes up by about 1% per year. From hell or high water, that's all it can do, because it's so expensive to find it and lift it out of the ground. So if you have any bit of increased demand, that's what pushes up its price. I do have some respect for gold because it does have a very, very long history as a central bank asset. It is useful in various industrial processes, and particularly it's rather beautiful for jewelry. So it's got some virtues. And I do think that it makes an awful lot more sense than cryptocurrencies, which I think are just a fraud. I don't think people should be involved in them at all. Having said that, I will say that if you go back to 1980, look at the price of gold then, and you look at the rate of inflation, gold has just, on average, has matched inflation since 1980. It's had a good run up the last few years, but since 1980, it's matched inflation. And I can't think of any long-term asset that's still as bad as that. I mean, people talk about something being as good as gold. I actually can't think of any long-term asset that's been as bad as gold for investors. So I'm okay, up to 5% of an allocation, not going to hurt you. It's okay. It does diversify you, and it's kind of interesting. But I would not go crazy on it. And I don't think ultimately, I don't think it's the center of a long-term investment portfolio for somebody who's trying to save for retirement.
And I think like there is no price to earnings ratio on gold, right?
Absolutely.
We can't go back and go, oh, as an asset, it's doing really well because it's got these XYZ factors. It's really just like we're expecting someone to buy it for more than I paid for it.
Yeah, it's the greater fool theory. But again, in the era of Bitcoin, I can think of greater fools than the people who are buying gold.
So I'm so glad you mentioned crypto, because as a financial advisor, I probably get asked 3 or 4 times a week about gold, but I probably get asked every single day about crypto.
Yeah.
And so what are your thoughts? And I think people are probably heading to crypto because, and the people that I watch on, Twitter or TikTok or things like that, they're very much like it's because of the Fed. It's because of the devaluation of the dollar. But in my mind, I'm like, but it's just a different kind of fiat currency. So why would it be exceptionally different?
Well, exactly. And the number one thing I get from people, sophisticated people or not sophisticated people, is they don't quite understand crypto.
Mm-hmm.
And the reason is because of the cryptography, because let me give you an analogy. Back in the 19th century, there were thousands and thousands of banks all over America. And if you were somewhat unscrupulous, what you wanted to do is set up a bank in a very remote area. So you might have the third regional bank of Sleepy Gulch, Wyoming, and you'd set up your bank and you'd have a little vault there. But the thing that you didn't need gold in the vault, because why bother with that? But you did need to have a good calligrapher, somebody who could draw beautiful banknotes. So we've got lots of beautiful banknotes from the 19th century. The third regional bank of Sleepy Gulch, Wyoming, will pay the bearer $10 in gold. And you'd send these out to the world, and your great hope was that they would never come back to you. Because if they didn't come back to you, you had nothing in the vault. But boy, are the notes pretty. And that is what crypto is. It is an empty box. The cryptography is fascinating. The idea that servers are whirring away in the desert trying to figure out prime numbers to break the code, to print another, to mine another Bitcoin. But then what's backing it? Nothing. It's just a pretty box which is empty. And, I think one of the things that's going on with Bitcoin right now is the advent of stable coins, because they introduced stable coins, they passed the Genius Act, and I think it's very badly named, but
Usually is.
but the thing about a stable coin is, at least the way they have now regulated it, it has to be backed by treasuries. So if something is 100% backed by treasuries, now it doesn't pay you any interest. So I don't know why you're doing this. I mean, just buy the treasuries and make the interest. Why buy a stable coin and pay no interest? It's much harder to use in transactions, but okay, you won't lose any money either. At least I'll just start thinking about inflation. But once you have a stable coin, you say, okay, well, at least this thing's backed by treasuries. But well, what's Bitcoin backed by? I mean, you're saying Bitcoin's going to be a currency, but it can't be a currency because a currency has to be stable. I mean, you're not going to sell me a car and I'm going to buy, pick it up from you in a few days and hand you over a certain price in Bitcoin because you don't know what that price is. I mean, it could be 10% higher, it could be 10% lower. That a currency can't operate that way. And the only thing Bitcoin's supposed to be is a currency, but it cannot fulfill that function. So in fact, what it is a focus of speculation. But unlike gold, there's nothing unique about it. I could come up with Zitcoin or Mitcoin or Davecoin is actually my favorite. When I was
I
thinking
like
initially.
Davecoin.
Yeah,
I'm a
exactly.
buyer.
Your Dave coin, I'll just keep the first 20% for myself, and you're welcome to the rest. But there is nothing there. And so it is a completely fraudulent asset. And it's I just hate the fact that so many politicians have been bought off on both sides to pretend that this is important, that financial institutions say, well, if you want to house your Bitcoin here, or we don't want to be passé about this, so crypto might be really interesting. And it's just all nonsense. It's just a fraudulent asset. There's nothing there. It is a modern Ponzi scheme. And but worse, because at least with Ponzi, they presumably had some money left in his house when people were collecting. There's nothing there. So I wish people wouldn't. I mean, I don't want to. I know that a lot of people who are feeling pretty miserable after watching Bitcoin's down about 31% since where it was in October. I'm sure there are a lot of people who are sad about that and licking their wounds. Honestly, the correct price is 10 cents. It's
Yeah.
not
And
worth
then,
it.
and then, the way, if you listen to the crypto people, they're going to talk that it's just like a stock, right? So this, like when a stock goes down, you buy more of it if you believe in it. And I feel like that's kind of like what's going to happen here is that, they're going to use it as a way to like get more people into
Yeah.
it.
But you and I know the difference between that because Procter and Gamble makes actual money selling toothpaste. There's actual earnings. A bond pays you a coupon. There's actual money there. Bitcoin is like gold, and it's only worth what the next person will pay you for it, but it doesn't have anything like gold's history. It doesn't have any industrial uses or jewelry. It doesn't even exist in a physical sense. There's nothing backing it. So there is no floor. For a stock, there's a floor which is created by the earnings the company itself will earn. Eventually, Warren Buffett will come in and buy it because it's a deal. Warren Buffett ain't coming in to buy Bitcoin.
Right. I feel like his attitude towards it is extremely similar to yours as well.
Yeah. Yeah.
And I have used, so people ask me all the time about it. And so when I tell them, I don't know everything about it. I do know that when my physical trainer, my massage therapist, and my ex-wife all asked me about it in the same exact day, that it very much has a tulip mania feeling to it. And so I tell people, like if you're, the whole goal of it is exactly what you said, which is we want the person behind us to pay more for it than us based on really nothing. And that is the definition of a Ponzi scheme, right? But in a Ponzi scheme, the people who get hurt are the last people in.
Unfortunately, that's right. I mean, I talk to lots of taxi drivers and so forth, and we get on to talking about finance, I talk about Bitcoin, and then I realize, wait, you own it, don't you? Yeah, I do own it.
Yeah. Yeah, it's tough. It almost does feel like almost like a tax. Like lottery tickets are a tax on the poor. And they've done the math on it and they find that, the people who buy them are overwhelmingly poor. And so they're taking that money and they're taking some of it and they're using it for themselves, but they're also taking it and giving it to schools and stuff like that. But it really truly ends up being a tax on the poor.
That's exactly right. I actually, years ago, I worked for the state of Michigan and I actually forecast lottery revenues for them. And looking at all the data, that is exactly it is. It was the biggest area of lottery sales for the state of Michigan on a per capita basis was Flint, Michigan, which was one of the poorest cities in the state. And that's what was doing it.
Yeah, and I feel like crypto has a lot of that same vein in it. Not that it's all poor people. There's plenty of very millionaires, who got into Bitcoin when it was 30 cents a coin and whatever. Yeah. And I don't want to disparage that as well. But my stance with it typically is that I would treat it like any sort of really, really speculative stock. You know what I mean? Like don't put all your eggs in that basket. Don't put any more into it than you're willing to literally watch go to zero.
Exactly. I mean, it's your Vegas money,
Yeah.
if you like
I
Vegas.
like that. That's Vegas money. I like that a lot. That's really good. Yeah. So globally, we're based on what I'm hearing you say, like we should be looking at diversification of some things outside the top 10 stocks that are really rolling. International sounds like you
Yeah.
said, 35% of the world is international stocks, but most people's portfolios probably 10% or less international. So maybe beefing up international a little bit. How do we feel about bonds? I mean, interest rates, I've been telling people that interest rates were going to come down for 3 years now, and they just don't want to bring them down. And I see why, but I mean, at the same respect, bonds typically are reflective of interest rates.
Yeah.
And so where do you feel bonds are going to go?
Well, we've had, the Federal Reserve obviously was raising short-term rates, and now they've been cutting short-term rates, and we'll see. It's a close call as to whether they cut them again in December, but I do think they'll cut them 2 to 3 times over the next year. And then sort of getting back to the economy, which I really didn't, go through here, but I think what's going to happen with the economy is it's pretty slow in the fourth quarter of this year, for lots of reasons. It's going to speed up early next year because of a lot of income tax refunds. But then once those income tax refunds are spent, I think it's going to slow down again in the second half of next year. And by the end of next year, I think we're down to 2% inflation again. We've got all this tariff inflation, but it's going to work through the system. It's going to leave prices higher. But the inflation, which is the rate of change of prices, is going to come back down to 2%. And it could go below that in 2027. And then I think the Fed could resume cutting short-term rates. But when it comes to long-term rates, you've got a more interesting position. Right now, we're at a little bit over 4% in a 10-year Treasury. And if you go back in the 50 years before the financial crisis, the 10-year Treasury yield averaged 2.7 percentage points above core CPI inflation. So if you had core CPI inflation going forward of 2%, that would argue for 4.7% 10-year Treasury yield. Now, you're already well below that. And so if the economy doesn't go into recession, then given the amount of money the federal government is borrowing, and given the fact that they keep on putting stimulus into the economy, which could cause inflation down the road, I don't think you get much of a rally out of the bond market. I don't have any problem. You get 4.25 on a 10-year Treasury, or you get, say, 4.5% on the Bloomberg Ag index of corporate bonds and corporate and treasury bonds. That's okay. And the one thing you know about the bond market is there's actually a very strong correlation between the yield you get today and the return you're going to get over the next 5 years. It's pretty much the same number. So you buy 4.5% bonds and you'll get paid 4.5%. It's pretty low drama. And there's nothing wrong with that. I think I wouldn't knock that at all. I think it needs an allocation in there, and if something does go wrong with the equity market, then bonds will rally, and that'll help you out. They will zig a bit if the stocks zag, and so I think it's fine having bonds in a portfolio. The only other thing I'd say about it is I wouldn't make a big bet on credit, things like high yield bonds, because those credit spreads are pretty tight, and I wouldn't make a big bet on duration, which means long term rates are definitely going to come down a lot because honestly they're not that high. So I'd keep it pretty close to the benchmark. Just have a good slug of bonds in a portfolio, but pretty neutral allocation.
Okay. I like that. So now, one of the things that you've been doing this for a really long time, what are the most dangerous piece of conventional financial wisdom that everyone believes, in your opinion?
Well, the one piece of economic idea they get completely wrong is that when the Federal Reserve cuts interest rates, it actually helps the economy grow. One of the ironies, the administration's been putting a lot of pressure on the Federal Reserve to cut rates. And some people think they should, and some people think they shouldn't. I don't think they should, but maybe I'll get back into that in a minute. But what I do strongly feel is that if they do cut rates, it won't stimulate the economy. This is not your grandfather's economy. You cut rates in the 1950s, you see a big spike up in investment spending, home buying, and all that stuff. But today, when you cut rates, people have actually got more short-term interest income than they have short-term interest expense. If you cut rates, you're actually going to hurt American consumers in terms of, a lot of people are going to have lower income on the money market funds and their CDs and so forth. And, almost everybody's in a fixed rate mortgage, so it doesn't help there. The credit card companies aren't going to really lower your rate anyway, just because, hey, if you pay 23%, you'll pay 24%. Why should they lower the rate? And so they don't really get much of a break. Meanwhile, when the Federal Reserve cuts rates, if they cut rates, well, they're probably going to cut more. So you want to borrow money now, you want to wait. Well, I think I'll wait. And so it causes this wait and see mentality when they cut rates. It also tells you, if they do cut rates in December, it'll tell you that the Fed's really scared that the employment situation is getting really bad. So is that going to help the economy grow? It's going to hurt. It's going to hurt. And that's what I think people don't get. Over and over this century, we've seen when the Federal Reserve cut rates to stimulate the economy, they didn't get stronger. And when they raised rates to slow the economy down and could have put it in recession, they didn't put it in recession. Yes, the Fed raised rates a lot in 2022, but it didn't put the economy in recession. It's
Right.
not going to. And so the thing that I think people get wrong is the assumption that the Federal Reserve controls the economy. And that actually gets me back to the point about why I don't think they should cut rates. What they do though is they cause asset bubbles. When you bring mortgage rates down to 3% on a mortgage, or then it's going to cause home prices to soar. And a lot of people are yelling at the Federal Reserve about affordability and housing market. The reason we've got a problem today is not because mortgage rates are too high; it's because they kept them too low for 15 years. And when the price when a mortgage was at 3%, that caused prices to go up and up and up. And then they snapped the trap shut by raising rates back to a normal level. And now there's a whole generation of potential home buyers who just can't afford the mortgage.
Right.
So
Right.
that's why you don't want to. The economy's got problems, but the economy's problems are all on the supply side. And cutting interest rates is not going to help with those problems.
Right. Right. Now, and I do feel like, like with housing, it really has, exploded as far as pricing, and I think that, people are now trying to like look at a house and they've got a 6.5% interest rate, but the house has gone up, almost 50% in the last 6 years. And it's like these, the younger people specifically, they can't buy a house. They can't afford a $6,000 mortgage. So I don't know that interest rates cutting. So you're saying that interest rates cutting won't help that too much.
It won't help that too much, and it could cause a future problem. I do think that we will slowly work our way out of this problem, but that's what happens when home prices get too high. If you look at, for example, the Japanese economy, they had a big housing bubble, which was as bad as anything we saw. But it took years for home prices to come down to an affordable level because nobody wants to sell at a loss. And in fact, a lot of people don't want to sell at all because they've got a mortgage right now, a 3% mortgage. So if they sell buying something else, they're going to take out a 6% mortgage on that. So why do you want to sell? And so the supply all dries up because of the way that our mortgage market works. But no, I don't. I think that there are things that we should do. If we wanted to free up the housing market, we could try to find some way of making mortgages assumable. And I'll come back to that. But you have to fully compensate the banks and the mortgage bond holders for that. But I think that would be a great scheme if you can say, look, I've got this house I bought a few years ago. Now I need to move, but I've got this 25 years left on this 30-year mortgage. That's 3%. I'll sell you my house, but what's more, I'll sell you my mortgage.
Right.
And that if we could do that, that would free up the housing market. And obviously, if you do that, then the bank loses money on that transaction. And so the banks have to be compensated and the bondholders have to be compensated. But if I ruled the world, I would work on that problem. I would try and say, look, I don't want people stuck in houses they shouldn't be stuck in because of mortgage rates. Because there are a lot of older people, two people, one people rattling around in these sort of 4 or 5 bedroom houses all over America. We're not actually short of bedrooms in this country. It's just the people who own the houses can't get out of them. The people who want them can't get into them.
Right. Right. I think that a lot of people's plan is just they're going to die and give them to their kids.
Yeah. Well,
And then,
unfortunately, that's the way the mortgage laws and the tax laws work. It's just not.
yeah.
It makes sense.
I saw something the other day on the assumable loan thing, and I thought that's brilliant. It really is. It's basically like a reverse annuity. You've guaranteed, exactly how much outlay you're going to be, and so you can just like take that and take some inflation off of it, and that's going to be very interesting.
Yeah, I think it's an interesting mathematical problem figuring out exactly who gets compensated, but it would free up the market, would get rid, and I think that would deal with the housing problem.
What do you think, like if you were 30 again, like how would you advise people who are listening to, have like an overall strategy for investing? What's the best vehicles to use to build wealth when you're 30?
Well, I think the first thing when you're 30 is invest in your own career.
Mm.
When I think back of the various things that have happened to me over the years, I think I've been lucky. But the mistakes I've made myself are hanging around too long in a job that was never going to work, or hanging around working for a firm. If it's not working out, I've always. I remember a few years ago I had the real privilege of being a commencement speaker for Michigan State. And so I made this speech and I talked about, you think about all the jobs out there. Now it's like a big Venn diagram. Now draw 3 circles: what you're great at, what you love, and what's going to get you paid. And there's an intersection of those 3 circles. And that's where you got to focus. And if you're not in that intersection, then fix things. Don't just sit there and wait for something to happen to you. It's actually like in finance. Don't wait to diversify. The market will diversify you. But make a decision. Be nice about it. Do the best you can in the job you're in, but make a move to something that's more suited to your talents or your real passions, or something that's going to actually pay you to do the job. Make those moves and invest in your own career and your own brain, because that's your biggest asset. Invest in that. Comes to how to put the money to work, put it in long-term assets, diversify it, but don't get too cute. I mean, I think there's a great need for active management because there's so much mispricing within the market. But people are always asking for a hot stock tip, and I'm not going to give you a hot stock tip. B, I don't have one. C, if I did, you know what? That's the easiest way to get burnt.
Right. Right.
It's about doing it right and investing in long-term assets. Don't get too scared. Realize it's like marathon running. You don't start off too fast. You don't be too aggressive, because you got to make it a long way,
Right.
and you got to plan for a long way.
Investing in yourself is probably the number one thing people should do, because I feel like, we go through primary school, primary education, really to become employees.
Mm-hmm.
And then when you get to college, you can kind of choose a path, but it still feels like you're going to be an employee. But I feel like a lot of people will get into a job, like you had said, they don't really like it. They don't really
Mm-hmm.
like it, but they're getting decent money.
That happens to almost everybody. That some terrible thing happens to their company and they're laid off, and they feel like this is the worst day of their lives. And it is amazing the number of people who will tell you that you don't realize this is your biggest opportunity. What's amazing is you don't believe that, but it's actually true. I've seen it over and over and over again. It's a job, or it'll find a way of separating itself from you.
I had a friend of mine call me the day that he found out I got laid off. I think he had left the industry, but he called me and I answered the phone. I was like, "Hey, what's going on?" He's like, "Welcome to the other side." And I was like, well, that was a weird thing to say. It was very positive in a very
Yeah.
negative emotion moment. So,
Yeah.
but I think that you're right. I think that if you're in a bad situation, that ultimately it will correct it for you if you don't correct it yourself. So
Yep. Exactly.
I like that. Now, obviously health is very important to you. This is kind of just an out there question, but it's kind of fun. So if you had to choose, would you choose perfect health at 80 or $10 million at 50? You're an economist. I want to hear the trade-off.
I'd pick. I'd grab the perfect health at 80. I
I like
don't.
that.
But it's dollars are dollars. I mean, there are an awful lot of things. I live in a house full of stuff. How much of that stuff do I really need? I don't actually need that much. You need to. I mean, it's nice to be able to pay the bills and deal with what you need to deal with. And if you can't, that's miserable. But you don't need to be incredibly wealthy. But having great health to 80, that would be something lovely. I like life, and you can't enjoy life as much as you should if you're not healthy. That's why it's important to look after your body. You've only got one. You just look after it. I say, go running, pay attention to what you eat. I try to get enough sleep. I do plenty of exercise, eat properly, and drink plenty of water. Do those four things here, you'll probably be healthy.
Yeah, no, I like that. That's good. And I think that's, it really is more of like a mindset, right? So like you said that and you were so, passionate about your answer to it. And I would tell you that, you would probably ask 100 people and get a bunch of different answers. Like you're not gonna get like, oh, definitely 80 and healthy. You're gonna have some people like, nope, 50 and 10 million. That's definitely what I want, because they just want to go spend it, have a good time, and they don't care about the future. So I think it's a really good exercise in delayed gratification, but also understanding that we are finite beings. We're not gonna be here forever. So
Yeah,
that's
that's true.
excellent. Well, so the one other thing I wanted to kind of say is like, you basically explain complex topics very simply. Can you give us like a 30-second take on like where you see this market headed?
I think it's so. I think that right now the overall equity market, we're going to have a correction at some stage. I think over the next few years it'll probably go up a little bit, but I think that people should not look back the last 2 years of double-digit returns, returns in the 20% range. They should not regard that as normal. I think there's plenty of opportunities in global markets. They're just not in U.S. large cap equities. So I feel good. I feel good about the economy. Long run, I think the economy will look after itself, but I think the market is a little expensive relative to the economy right now, and the U.S. large cap equity market is a little bit expensive, and so I'd want to diversify. This is a time where your resolution for 2026 should be rebalance. Make sure you're diversified. Make sure you're not overexposed in what is a over exuberant market.
Okay. Yeah, that's really great advice. I appreciate that. And I hope the listeners appreciate it and listen to it. Because that's, that's a big part of it too, right? Is that, if we all kind of go to our financial advisors or, set a rebalancing or kind of say, listen, we're going to go a little more international right now because, of what's happening, then it's a slow, change and it doesn't affect the market as badly. What we've noticed is that sometimes you'll see things where good companies like lose tons of value because of people having to liquidate to
Yeah.
do something, and that's where I think you make bad choices because you're forced to liquidate. Like you said, the market will do it for you.
Yeah, and yeah, sort of getting back to where we started, it requires a certain amount of discipline. That's kind of, but exercise is also discipline. And you put in the miles on a cold
Mhm.
morning, you don't feel great about going out first thing in the morning, but after a while, you feel better about it. But you have to be thoughtful about it and disciplined about it. And to me, that's kind of like asset allocation. I mean, the right asset allocation, I often say, it's a little bit like home insurance. You hope you're never going to need it. You don't know when you're going to need it, but you should never sleep comfortably not having it. And if you're overexposed in overly speculative areas, you could get beaten up pretty badly. So I think it's the growth of the global economy, the growth of the stock market in the long run, global stock market, it should amplify your wealth if you're in the right job and you're doing the other things you need to do. So you don't need to get greedy here. I think this is a time where people just need to be very disciplined going into 2026.
I like that. That's really good. Thank you so much. Is there anything else that you want to talk about before we take off?
No, I just want to wish everybody a very prosperous new year. We hope that it works out that way, and a very peaceful and happy holiday season.
Thank you. Happy holidays to you as well. I do want to ask you, do you have a marathon coming up?
Yeah, I'm gonna run the 2026 Boston Marathon. It'll be the eighth consecutive year. I run it every year for the Dana-Farber Cancer Institute. Is just I only run one marathon a year, but I love running Boston.
Okay, and you're running on behalf of a charity, is that what you said?
Yeah, I run for the Dana-Farber, who's a cancer institute, and they do wonderful research. One of the world's leading researchers on cures for lots of different kinds of cancers, as well as treating many thousands of people. And so they do a lot of great work. And the team that I run on, I mean, everybody raises money, and it's they've all got a story. And some of them are a little heartbreaking, but it's wonderful when I go out and team runs, just seeing how they can find purpose in some of the darkest days of their lives because of some relative or some and who cancer has struck, and they put in their miles, they work hard at it, they raise money, and then we all line up in the third Monday in April in Hopkinton, and we run the Boston Marathon. And it's a kind of highlight of my year.
Nice, nice. That's really cool. Now, the Boston Marathon, you have to be invited to be in it, correct?
Well, you have to have a Boston qualifying time to if you're not in a charity. Now, I do actually have a qualifying time because of my great antiquity at this stage, because it does get easier as you get older. But
It's a great way to
but
say
I
that.
but you don't have to have a qualifying time if you run for a charity. A lot of people who aren't natural runners, but this has just been important to them to do this, to try to raise money and to do this personal thing, to try to put in the effort to help with the cancer cause. That's great. I mean, there are a lot of charity runners in Boston Marathon, and I think it really adds a lot to the.
Okay. Well, thank you again for so much of your time. I found it to be fascinating and I knew I would enjoy it, and I really did enjoy it. And I would love if you would come back on the show, like 3 or 4 months, and let's do this again and talk about what's going on in the market again, if that's something you'd be up
Well,
for.
I'd very much love to do it again. Let me get my marathon under my belt first,
Okay,
though.
good point. Good point. We'll wait till the marathon's over.
All right,
All right.
fair
Well,
enough.
we're all rooting for you, and
All
we're all
right,
rooting for you to raise tons of money for your charity as well.
all right. Well,
So
thank you, Chris.
thank you so much for your time, Dr. David Kelly. It's been just a great time with you.
All right, thank
All
you.
right. And thank you all for listening. You guys know the drill. Like, comment, shares. That's what helps the algorithm know we're out there, helps spread the word, and get more exposure for these really good talks that we're having. So thank you all for listening, and have a great day.